So Donald Trump is threatening new tariffs, and today I'm going to give you a short bottom line of what's going on, in my opinion, of why they matter, and then I'll also talk to you about what the Federal Reserve has to say. And sorry I sound a little raspy today. I'm practicing my RFK voice. Hey everyone, me Kevin here. Did you know you can get life insurance in as little as 5 minutes? Go to metkevin.com/life, paid partner of the channel. Okay, tariffs. Trump this morning threatened 50% tariffs on the EU starting June 1st. That's about a week away, all right? 25% tariffs on Apple products if iPhone production isn't moved to the US. These are just threats right now. They're not actually levies, but June 1st is like 8 days away. Kind of crazy because that means the coupon expiration for the Alpha report is like 8 days away. That's crazy. Actually, it's like 7 days away. But anyway, here's what you need to know about this. The value of EU tariffs compared to China. Trade with the European Union sits at almost $1 trillion per year. And we have much more balanced trade with the European Union. Trade with the European Union sits at $975.9 billion. We import about $1, or sorry, let me rephrase that. We import about for every $1 and for every $1.6 of imports we take from the European Union, we export to them $1. So 1.6 to 1. In other words, we still import more than we send to them. It's about $605 billion versus $370 billion if you use 2024 numbers. Compare this to China. China, we import about $4 for every dollar that we export there. So you have a much more balanced situation with Europe, but I'm not so worried about the balance. The balance just sort of suggests that there's going to be a broader impact to damage if we really ruffle trade with the European Union. It's no longer just like furniture or toys and TVs like with China. Could be substantially more broad. What I think matters is that trade with the European Union is actually 67% larger than it is with China. Chinese trade is about $582 billion, 2024 numbers. And that makes the European Union 67% larger in dollar volume trade. So in other words, a trade war with Europe on a dollar volume scale is 67% worse than a trade war with China. Now, mind you, the tariffs on China are still sizable. They're still 30% for at least the next, 60 to 90 days. TBD how things actually play out. And a lot of companies have really pulled forward inventory in March, but now that we've had this sort of pause of tariffs in the second half of April and going into May, and we have the threat of these European tariffs starting within next week, I actually think we're going to see sort of a 2.0 pull forward, where you have even more of a pull forward of demand. So actually, over the next few weeks, economic data is probably likely to look good, and it could be supportive of this sort of buy the dip mentality in stocks. The problem is, the more of this pulling forward we're doing, the more we're taking good data from the second half of the year, and we're bringing it forward to the first half of the year. That's good today. It's bad in the future. Probably. Especially since the European Union, at least in Donald Trump's words, are, quote, very difficult to deal with, and that our discussions with them are going nowhere. All right, here's the thing. The higher stocks go, the more aggressive Donald Trump is going to be on tariffs. The lower stocks go, and the more of a shock the financial system has, the quicker Donald Trump U-turns. Therefore, it is my opinion that buying the dip early in the EU trade war doesn't make much sense, because as stocks are near all-time highs, Donald Trump will be more aggressive. Donald Trump gets weaker when we get closer to the Trump put levels, which are closer, well, at least according to the last time, when the S&P 500 hit about 4,900. That's when Donald Trump started panicking at the same time as we were having a crisis in the bond market. Okay, right now we're at about 5,800 on the S&P 500. So what's a simple strategy here? You don't need to flip-flop and dump everything. This is very simple. We talk about this all the time in the course member live streams. If you want, you take a portion of your portfolio, let's say that trading 10%, or if you have 10% margin, you take that edge 10 or 20% of your portfolio, you set trailing stops. If they trigger, great. Then set buy stops going back in. So if the market falls, say, 4% on the Qs or the S&P 500, you sell that 10, 20%, you pay off your debt. Then you set buy stops. So basically, if the market rebounds 4%, you go buy again. This is just an example, right? It's not personalized advice. And that's one way that on the edge of your portfolio, you can make sure you have some cash to actually buy the real dip with, and you're not in margin. Okay, cool. Bottom line, out of the way. Now, what does the Federal Reserve say? Well, the Federal Reserve actually yesterday via Waller said that 10 to 18%, we could probably still cut by the end of the year. That was bullish. It's like, really? You still want to cut rates even though we have 10 to 18% tariffs? That's impressive. Cool. That helps soft landing narrative. Great. We want soft landing. We don't want pain in the economy. This is, look, again, and people are always like, oh, Kevin has a huge bias. I actually don't think I do. It doesn't really matter to us what happens. Is that the economy keeps booming. We just keep building accessory dwelling units over at House Hack. In case you're not familiar with what that is basically you take a house, and then in California, in parts of California, you could turn these houses into like 3 or 4 unit apartments, basically. So you have a house plus 3 units, which is just like crazy because you can make a lot of money on your investment just because the values are so high in certain coastal regions. It doesn't work everywhere in California, just certain areas. And you don't want to do that, obviously, with your whole portfolio, right? Anyway, you want to learn more about House Hack, you know you can get a 5% yield through conversion and all the upside in the stock. Obviously, risk with every investment. Go to househack.com to learn more. But that's our, soft landing narrative. If things go poopy doopy, we got plenty of cash to go buy the dip, and we would be excited to buy when interest rates are lower again. Okay, so Goolsby this morning says if you do big tariffs like this with the EU and you start complaining about VAT tariffs and this negotiation takes a whole lot longer than the Chinese negotiations because Europe's going to be more stubborn, then we're going to be in a stagflationary situation. And that means we have to wait even longer. See, with Europe, or I should say with China, China can probably sustain these 30% tariff rates on them because they've been working on decoupling from the United States. I don't know that we really want these extra, this extra damage to our earnings per share in markets, but whatever. This is why most institutions seem to be dumping stocks right now while retail is buying. Hedge funds are selling, institutions are selling, largest amounts that we've seen in quite a while, and retail is literally doing the opposite, which to me it feels a little, the Buy the Dip song, where at the end of the Buy the Dip song you have Charles Payne, and he's like, you're just mad because retail's now doing what you're doing, and now you're losing and they're winning. You remember that? I actually think it's really interesting because that was around the peak of the market at the end of 2021. So I don't know how well it bodes for us actually discounting real risk in the market right now, especially since retail is buying the dip like freaking crazy while, hedge funds and institutions are selling. You can see this really clearly. I mean, plenty of people post about this over and over and over again. But here you can see 4-week average of hedge fund selling, 4-week average of institutional selling, right? Negative lines over here. 4-week average of retail buying, okay? Retail is buying, everybody else is selling. This is according to Bank of America, at least. Who knows? Maybe Bank of America is smoking. But I feel like people are just buying the dip. It's like, oh, cool. Another tariff opportunity. Great. It means I get to buy the dip more because I missed the first dip or whatever, right? Or we're just building more risks in the economy, and at some point the bill is going to come due. Now, the good news is with buy now, pay later, it seems like the bill never comes due because now we are issuing $300 billion of buy now, pay later bonds, underwritten by corporate Wall Street entities to bring you back to a modern version of 2008. Basically, you take a pile of garbage, you wrap it into something you call an investment vehicle, you slap a AAA rating on it, and you sell slices of garbage. That's what's now happening, and you know what? It's working. I tweeted yesterday, or posted yesterday, that Walmart, Ralph Lauren, and Home Depot see no consumer slowdown yet. What do all three of them have in common? They all offer Klarna, buy now, pay later, baby. In the meantime, Bank of America, at least Mr. Hartnett, is now recommending that you sell hubris and buy humiliation. Now, what could humiliation be? Well, on a 10-year rolling average of returns, humiliation has to do with, treasury bonds. Oops, US 15-year plus treasuries. Ouch. This is basically just a slap in the face to TLT, although he is saying buy the dip. Except instead of saying buy the dip, he's saying buy humiliation. Yeah, I get it. It makes sense. Okay, then take a look at this. This shows you how the economy is slowing. Look at Mag 7 hiring. Left side, 2011 to 2021, money printers rolling. Look at under the QT era. when the Fed started raising rates and the vacuum cleaner turned on. Ouch. That's a whole lot less hiring. Obviously, jobs market is very slow and very lagging, so have to be very careful for shocks, and Donald Trump continuing to add shock risks here, probably not great, but whatever. In the meantime, retail has found their favorite investment, and that is crypto. Inflows into crypto since 2019 are basically at the moon, whereas we're starting to see outflows in gold. How interesting. Okay, what else do we have? Actually, that's all I have today. Go to househack.com.